Assalamu alaikum. My name is Bint-e-Atif. Welcome to Smart Commerce Classes. Today we will do 7707 October-November 2021 variant 22. Okay. Moving towards first question. Aisha is a trader who maintains a full set of accounting records and prepares control account at the end of each month. She provides the following information for the month of August 2021. We have balances first on 1st August, then we have total balances for the month. Okay. We are required to make sales ledger control account and purchases ledger control account for August 2021. Okay. So for sales ledger control account, we'll be needing balance on 1st August, sales ledger control account, debit balance and credit balance. We will be needing sales, credit sales. We'll be needing receipts from customers, discount allowed, irrecoverable debts, sales return, interest charged to customer on overdue amount, and contra entry. And we have sales under control account credit balance, balance CD. Okay. Moving towards balances, balance BD. That is 9,800. We have sales. That is, then we have interest. That is 90. Then we have balance BD, that was a credit balance, that is 420. Then we have sales return, that is 2,400. We have payments from customers or bank, that is 8 to 100. We have bad debts or irrecoverable debts, that are 300. Then we have contra, that is 2,920. We have discount allowed, that is 900. And we had sales control has a credit balance brought down on 1st September 2021. That means on credit balance was on 1st September, and we are making the account on for August. That means balance CD will come on debit side. Balance CD will be 350, and date are very important. So 1st August. 1st August. And these all items will be at 31st August. Okay, 31st. Okay, then we have total 9,800 plus 8,850 plus 90 plus 350, that will be 99,090. So balance CD will be 9,090 minus 420 minus 2,400 minus 82,100 minus 300 minus 2,920 minus 900. That will be 10050, 10,050. Okay. Okay. So balance BD will be 10050. Balance BD at 1st September will be 350 on 1st September. Okay. Then we'll make purchase ledger control account. For that, we'll be needing purchase ledger control account credit balance 7700, credit sales. We'll not be using cash purchases. We'll be needing credit purchases. That is 5,400. Then we'll be needing payment to credit customers, discount received, and contra. Okay. So balance BD. We have only one balance. Okay. So that is 7,700. Purchases. Only credit purchases, not cash. Okay. That is 55,400. Then we have payments. Oh, the payments to credit supplier that are 50,600. We have discount receive that is 600. We have contra that is 2920. And now we'll add up 7,700 and 55,400. That will be 63,100 and 63,100. So we'll deduct 50,600, 600 and 2920 to get balance CD. That is 8980. Okay. 31st August, 31st August, and 1st August. Okay. Okay. Then we have balance BD on 1st September. That is 8980. Okay. Moving towards question B. Name the book of prime entry which Aisha would use to obtain the following information when preparing her sales ledger control account. Returns, discount allowed, interest charged to customer on overdue account, contra entry. So returns are included in the sales return. Sales return. There are 6 books of prime entry. Sales journal, sales return journal, purchases journal, purchase return journal, general journal, and cash book. Cash book is a ledger. Cash book is a ledger, and cash book is a ledger, and cash book is a journal entry or prime entry as well. So sales return journal. Then we'll add discount allowed comes under cash book. Interest charge on customer comes under general journal. Okay. Contra entry also come under general journal. Moving towards part C. Suggest 2 reasons why the sales ledger control account had a credit balance of 420 on 1st August 2021. So there could be a reason that that customer has bought something and returned back the item, and we haven't paid them that amount. For example, the customer has bought goods from us for 500, and they were not satisfied with 50 amount good, for example 50 rupees good, so they have returned us 50, so we have to give them 50 if they have given us or paid us 500. So their total amount was 450 and they paid us 500, so we have to pay them 50 rupees back. So that could suggest the credit balance on the sales control account, or the customer has overpaid us 420, or the customer has paid us in advance, that 420 is paid in advance and he have to buy goods in likely future for 420. So that will come under the credit balance in the sales control account. Okay. Moving towards question 2. Jabir owns electrical wholesale business. The following balances appeared in his books on 30 September 2021. Inventory, purchases, trade payables, revenue, trade receivables, operating expenses. The inventory, okay. All sales and purchases were on credit basis. Calculate the gross profit and profit for the year. For gross profit and profit for the year, we'll be needing inventory, purchases, opening and closing. Okay, opening inventory, closing inventory, purchases, and for profit, we'll be needing operating expenses. Okay. For gross profit, we need a revenue. We'll be needing cost of sales. That includes opening inventory. I'm making income statement. Okay, purchases. We'll be needing closing inventory. We'll be needing less expenses equals to profit. Okay. Or if you want to, okay, operating expenses, profit. Okay. So the revenue. Okay, we don't have revenue. Okay. So for revenue, oh, we have revenue, sorry. We have revenue of 160,000. We have opening inventory of 8,000. We have purchases of 109,000. We have closing inventory of inventory. These balances are on 30 September. So these are the closing balances and closing balance. That means this is the closing inventory, 8,000, and opening inventory was 1st September 2020 was 11,000. Sorry for the mistake. It is 11,000. This is 8,000. This will give us 112,000. Okay. So we have 160,000 minus 112,000. That will give us the gross profit of 48,000. Then we have less expenses. Operating expenses are 35,200. So that will give us profit for the year of 12,800. Moving towards B part, calculate the gross profit margin. Gross profit margin is calculated by dividing gross profit by sales, multiplying it by 100. So gross profit was 48,000, which we calculated, and revenue was 160,000. So if it's written margin, that means sales. If it is written markup, that means cost of sales. Okay. For gross profit margin, we'll be dividing gross profit, GP, gross profit, divided by sales multiply by 100. So gross profit is 48,000. Sales were 160,000, and we'll multiply it by 100. So it will give us the answer of 30%. Okay. So advise Jabir on 2 actions he could take to improve his gross profit margin. How can he improve his gross profit margin? First of all, if he increase the selling price or reduced trade payables, trade discounts on trade discount to customers, so his sales revenue will increase. If he and gross profit will also increase. If he obtain cheaper supplies or trade discounts on the suppliers, or buy cheap suppliers, or from a cheaper suppliers, so he'll be able to reduce his cost and increase the gross profit. Okay, moving towards C part, calculate the trade receivables turnover. Turnover means days. Round up your answer to the next whole day. Okay, that means we don't have to answer in decimals. So trade receivable turnover is calculated by trade receivables divided by sales multiplied by 365, or how many days? 365. Okay. Question C is trade receivable turnover is equal to trade receivables divided by sales multiplied by 365. So the answer will be trade receivables, that is 22600, that was given in the question, divided by 160,000 multiplied by 365. So the answer will be 52 days. 52 days. Moving towards D part, Jabir wants to increase his credit sales and is considering allowing his credit customers an extra 14 days above his current trade receivables turnover. He have 52 days credit credit turnover, trade receivable turnover. That means after 52 days, or within 52 days, his trade receivables pay him back. So he's considering giving them 14 days extra. That means he's allowing his trade receivables to pay him within 66 days, or after 66 days. So within 66 days. Okay. So advise Jabir whether he should allow his credit customers an extra 14 days above his current trade receivable turnover. So it is of 5 marks. So we have to write 2 points in favor of allowing him his credit customers 14 days extra, and 2 disadvantages of allowing him 14 days extra. So if we allow his credit customers 14 days extra, so his sales will increase, as more customers will want to buy goods from him, as he's allowing a 66 days uh, payment schedule. So it will attract more customers, sales will increase, profit will increase, and relationship with customers will also increase. Disadvantages would be that there will be delay in payment, there will be chances of more bad debts. He cannot, Jabir can also suffer with credit cash flow problems. And justify your answer means that 2 marks in favor, 2 marks against, and 1 mark for the evaluation or your judgment, whether he should allow or whether he shouldn't allow. So it's your choice. 1 mark is for free. Okay. E part is calculate the trade payables turnover. So trade payables turnover means trade payables divided by credit purchases multiplied by 365. Trade payables divided by purchases. If purchases aren't available, so we can divide it by cost of sales, multiply by 365. So we have 22600 divided by, so we have, sorry, 11600 divided by 109,000 multiplied by 365. So the answer is 39 days. Okay. Jabir credit suppliers are prepared to double the rate of his trade discount provided he increases his current monthly purchases by 20%. Additional trade discount. Justify your answer. Advise Jabir whether he should increase his current monthly purchases by 20% to earn the additional trade discount. Justify your answer. So if he'll increase his monthly purchases by 20%, he'll get trade discount. That means total cost will increase. Total cost of sales will decrease, sorry, will decrease. He'll be able to sell on lower prices or gain more customers, more market share. Low cost of sales mean that high gross profit. That means high gross profit margin and high profit as well. It is of 5 marks. So we'll write 2 points in favor that he should purchase, 2 points against that he shouldn't purchase by 20%, and 1 mark for the evaluation. So it will increase if he'll purchase by 20%, increase his purchases by 20%. So his trade payables will also increase. He'll also have cost of storage that he'll be needing a warehouse to store his goods. So the storage cost, holding cost, and wastage cost will also increase. Okay. Moving towards question 3, on 31st July 2021, the following information was provided by KA Limited, a manufacturer of a garden. So we have inventory, raw material, work in progress, opening inventory, purchases, carriage on purchases, direct wages, closing inventory, revenue. Okay. So we'll be needing, okay, we are required to prepare the manufacturing account of KA Limited for the year ended 31st July 2021. So for that, we need cost of material consumed. This is the heading. Okay. Opening raw material, purchases on raw material, then we have closing inventory. Sorry, we have carriage on raw materials. Then we have closing raw materials. Okay, we have opening raw material of 5820, purchases 34200, carriage 410, and closing inventory 6030. Okay. Opening 5820, purchases is 34200, carriage is 410, and closing inventory that will give us then we have direct wages. If we have direct wages, direct labor, or we have royalties, so that will come under prime cost. That will be included in the prime cost. So we only have direct wages. Okay. That is So the prime cost will be then we have factory overheads of indirect factory wages. We have indirect factory wages. We have factory depreciation, factory machinery depreciation. We have rates. We have general overheads. We have depreciation. That is, depreciation rate is given 20% reducing balance method. So we'll be needing cost and accumulated depreciation 47,000 minus 7,000 minus 11,000. That will be 36,000 multiplied by 20%. That will be 7,200. We have rates and factory general overheads. Factory general overheads are 230 accrued. And the rates are apportioned 75%. Rates are also accrued prepaid, and we have apportioned 75% factory and 25% of office. Okay. So general overheads are 16400 plus 230 that were accrued. That will be rates were prepaid. 5,300 minus 500 that were prepaid, and 75% belongs to the factory and 25% of office. That will be 3,600. So total will be 51,430. It will be added in 101,600. That will be 153,030. Then we'll be needing work in progress, opening inventory, and work in progress, closing inventory. So it will be work in progress, opening, and closing work in progress. Opening work in progress is 1,750. Closing is 2,780. That will be deducted. That will give us 1,750 minus 2,780. That will be 1,030 net. So it will give us 152,000. 152,000. That will be cost of manufacturing or cost of production. Okay, moving towards B part. Prepare the income statement trading section of KA Limited for the year ended 31st July 2021. So we'll be needing revenue. We'll be needing cost of sales. Which will include opening fixed finished goods. Then we'll be needing purchases of fixed finished goods. Then cost of production will be calculated in part B, part A, closing finished goods. That will give us gross profit. Okay, revenue is 2 to 3,000. 2 to 3,000. Cost of sales, opening finished goods were 1 to 3,600. Purchases were 3,900. We have carriage inward as well on finished goods. That were 90 to 80. Closing were 10340. Cost of production was 152,000. Okay, that will give us 158,000, and 2 to 3,000 minus 158,000, that will give us 65,000. That is the gross profit. And this comes under the trading section. And the other part is the profit and loss section that gives us the profit for the year. C part is DH Limited, a customer of KA Limited, has been declared bankrupt. A debt of 350 was owing to KA Limited. This is to be written off. As we have made control sales at your control account in part question A, question 1, and in it the bad debt was on credit side. That means that entry will be bad debts debit and DH Limited credit 350. Okay. KA Limited maintains a provision for doubtful debt. Explain how maintaining a provision for doubtful debt is an application of each of the following accounting principles. Matching, prudence. Okay. Matching concept states that the income for the year equates the expenses for the year. The exact definition is the amount of sales for which the business is unlikely to be paid. For provision for doubtful debt, it is an expense, so it will be included in the income statement. And income statement items are always included, always shows matching concept. And if it as provision for doubtful debt includes in the statement of financial possession, and if statement of financial possession item, all statement of financial possession item shows the prudence concept. As prudence states that the income and profit should not be overstated, and the expenses and liabilities should not be, or expenses, liabilities, or losses should not be understated. So Allah Hafiz for today's video.